April 15th is a week away. We are in the home stretch of this year's tax season. And for those of you scrambling to file quickly, don't make the mistake of leaving money on the table by not claiming all the deductions you're owed. Here with the most commonly missed deductions is Barbara Weltman. She is the contributing editor to J.K. Lasser's Tax Guides, including this one. Look at this. 1,001 tax deductions and tax breaks. Exactly what you need. Barbara Weltman is here. Barbara, welcome. Tell me, you are a big advocate of filing a long form because you want people to get deductions. Tell us about that. What money are some people leaving on the table?
Well, taking the standard deduction instead of itemizing can cost you write-offs that are due. Think about itemizing, for example, if you own a home, you live in a high tax state, you make a lot of charitable contributions, as long as you have the records to back up your write-offs. But recognize if you're 65 or older or blind, you're entitled to an additional standard deduction, which makes it a higher standard deduction amount.
All right, so bottom line here, what we're talking about is to get all of the deductions you might be due, you want to fill out that long form, do the work. You can either do it with a pro or you can do it with accounting or tax software, which will ask you all the questions you need to know. Now, we know about mortgage interest deduction. I'm assuming, we've got a pretty savvy audience out there. They know about that. They know about charitable deductions, state and local taxes, real estate taxes. They get that. But there are some things that people might not know about. Let's start with student loan debt. What portion of that is deductible?
Well, a student can deduct up to $2,500 in interest each year as long as his or her modified adjusted gross income isn't over a threshold amount and they're not a dependent. And they can take this deduction even if their parents or their grandparents, for example, pay their debt. So that's a way for parents to help a recent graduate financially. And again, the student, the graduate, gets the tax deduction.
Don't you have to make sure, though, that your parents aren't claiming you on their tax forms?
Precisely. You can't be their dependent.
You can't be their dependent. They can't be taking an exemption for you. Let's talk about that sandwich generation. I get this question all the time. What kind of benefits, tax benefits, are there out there for boomers, who might be supporting mom and dad at this point?
Well, you may be able to claim your parent as a dependent, take an exemption for your parent. And this gives you a write-off of $3,950 on your 2014 return. You can do this, for example, as long as you pay more than half of your parents' support and they don't have gross income over that exemption amount and you meet certain other requirements. Or if you and others, perhaps siblings, are paying more than half your parents' support and you have a multiple support agreement. But, even if you don't qualify for the exemption amount because, let's say, your parent has income over $3,950, you may still be able to take medical expenses that you pay for your parent as your own itemized medical expenses. Again, you have to pay more than half your parents' support.
And what's the limit on that? Because President Obama has changed that on the medical expenses that you can deduct as a percentage of your gross income. He's moved it up, right?
Could you repeat that? Because I didn't hear.
Oh, quite all right. I was just saying that, if you're trying to take medical expense deduction on your taxes, the president has changed the baseline number on that. He's moved it up.
Right.
I think it has to be 10% of your gross. Is that right?
It's 10% of your adjusted gross income. Or if you're 65 or older, it's still the old 7.5%.
Okay. And quickly, we're kind of running out of time here. If you're a teacher, you can deduct the stuff you spend for your little tykes. How much?
Well, you're exactly right. Your out-of-pocket classroom expenses up to $250. It's a write-off from gross income. It's an adjusted gross income deduction, meaning that you don't have to itemize. But even if your out-of-pocket expenses are more and the national average is over $500, you can claim the balance as an itemized deduction, a miscellaneous itemized deduction on Schedule A, subject to the 2% of adjusted gross income floor.
Well put, Barbara. There's a deduction out there for you, that's for sure. And we appreciate your help tonight.
Pleasure.